You're scrolling online, you see it, a trading strategy with unbelievable returns. And you have to wonder, right, is this thing for real? Well, today we are diving headfirst into that seductive world of AI trading. We're trying to tell the difference between genius and just plain dumb luck. Well, it's harder than you think. Let's get into it. Okay, let's just start with this number, 135.49%. What if I told you an AI trading system pulled that off in just 2 years? Yeah, that's the kind of number that makes you lean in a little closer. But where in the world did it come from? And more importantly, can we actually trust it? This isn't just some number plucked out of thin air. A recent research paper detailed this hybrid AI strategy, and it didn't just make money. It absolutely obliterated the market benchmarks. I mean, look at this. It beat the NASDAQ by over 40%. The S&P 500 and Dow Jones weren't even in the same league. This right here is the seductive promise of AI in finance. So, the big question is, how did it pull this off? Let's take a quick peek at the engine that's behind these absolutely incredible numbers. Right, so this is definitely not your simple buy low, sell high kind of deal. The system they outlined is, well, it's a beast. It sucks in all this market data, all the financial news, and then it gets to work. It's looking at technical indicators, all the math based on a stock's price and volume. Then it uses a machine learning model to hunt for hidden patterns that we humans would just miss. And it even has a sentiment analysis module to basically read the news and get the vibe of the market. It's super sophisticated, it's complex, and it's what produced that stunning return. Or at least it did on paper. But here is where we have to slam on the brakes. That amazing performance, it wasn't from live trading with real money. Nope. It came from a process that is both totally essential and at the same time dangerously misleading. It's called backtesting. And that really is the multi-million-dollar question, isn't it? Is this thing a legitimate money-making machine, or did it just get an A+ on a history test that I'll never have to take again? At its core, backtesting is really simple. You just take your brilliant strategy, you run it against data from the past, last year, the last 5 years, whatever, and you see what would have happened. It's the standard way everyone tries to see if an idea has any merit before risking a single real dollar. And this slide just perfectly captures the dilemma. On one hand, backtesting is our best friend. It's how we get data-driven proof. It builds our confidence, and it helps us sharpen our ideas. But on the other hand, it's a minefield. It's full of these sneaky little traps that can make a totally worthless strategy look like a certified gold mine. So let's go ghost hunting. We're going to uncover two of the most dangerous phantoms in the backtesting machine, overfitting and look-ahead bias. This is the absolute best analogy for overfitting. Imagine you can tweak your strategy so perfectly to the past that it knows every single little twist and turn that happened. On a historical chart, it looks like pure genius. But the moment you let it loose on the live market, a brand new test it has never seen before, it just falls apart. Why? Because it didn't learn the principles of the test. It just memorized the answers. And hey, don't just take my word for it. This isn't just some academic theory. This is a real comment from the algo trading community on Reddit. These are practitioners, people in the trenches constantly warning each other about this exact trap. It is so easy to fool yourself if you're not paying attention. Okay, the second ghost is even sneakier. It's called look-ahead bias. This is when your test accidentally uses information from the future to make decisions in the past. It's like having tomorrow's newspaper today. Of course you'd make a killing in the stock market. It's usually a tiny programming error, but it creates these impossibly perfect results that are just not real. So how do the pros fight this? How do they stop their models from accidentally time traveling? Well, they use these really rigorous techniques. The core idea is to carefully split your data into one pile for training the model and another for testing it. Then, and this is key, you purge or remove any data from the training pile that could have been influenced by what happened in the testing pile. Finally, you add an embargo, which is just a little time gap between the two, to make absolutely sure no information leaks across. It's this intense level of detail that separates a real professional backtest from a dangerously fake one. But even if you get a perfectly clean backtest, you're still not done. Not even close. A single run-through history just isn't enough. The pros take it one massive step further. They stress test their strategies against thousands of alternate realities. And this quote just hits the nail on the head. That worst loss you see in your backtest, what traders call the maximum drawdown, is almost never the true worst-case scenario. It was just the worst thing that happened to happen on that one single path through history. I mean, just look at these numbers. It's insane. A single standard backtest showed a maximum loss of about $1,600. Okay, maybe you can live with that. But when they ran a proper stress test, the potential loss was over $5,000, more than 3 times worse. Can you imagine setting up your trades thinking $1,600 is your worst day, and then you get hit with a $5,000 loss? You'd be toast. This is exactly why stress testing is absolutely non-negotiable. And the main tool for this kind of stress test is called a Monte Carlo simulation. It's a fancy name for a simple idea. It just takes all the winning and losing trades from your backtest and shuffles them up, like a deck of cards, thousands and thousands of times. This creates all these different possible histories, showing you the full range of what could have happened. It helps you see if your strategy's success was just a lucky sequence of events. So really, this is the crucial question you have to ask yourself. If history had zigged instead of zagged just a little bit, would my strategy have survived? A strategy that only works in one perfect version of the past isn't robust, it's fragile. What the pros are searching for are strategies that work across a wide range of possible histories, because those are the ones that have the best chance of surviving the completely unpredictable future. Okay, so what's the big takeaway from all of this? Here are 4 incredibly costly mistakes you need to avoid. First, don't use too little historical data, and make sure it covers all kinds of markets, bull, bear, the boring sideways ones. Second, as we've talked about, do not overfit your strategy to past events. Third, you have to factor in real-world costs, like commissions and slippage. They add up fast. And finally, always stress test your strategy to see how it holds up when things get ugly. And I will leave you with this one last thought. The next time you see a backtest with one of those jaw-dropping returns, just ask yourself this question. Because a real strategy is tough, it's resilient, and it's ready for whatever the market decides to throw at it. A lucky story? Well, that's just waiting for its luck to run out.